Hi there everybody and welcome back to another stock analysis video. Today I would like to analyze the company Blackrock. Now a lot of people may have some feelings towards this company because, well, they don't have the best amount of reputation, especially when it comes to the amount of houses that they have been buying recently. However, seeing that their earnings are actually coming out on the 13th of April, I decided, you know what, let's actually see if their fundamentals actually match their share price and come up with an intrinsic value for this company, just to see if maybe we would like to invest in this company and take part of all their profits. So with that said, let's get started with this analysis. Now guys, we're going to come over here to the dividend summary, and this is actually something that really attracted me to Blackrock when I first saw them. Now I personally don't own them, but when I first saw this I was taken aback because I have never seen such a huge dividend yield. Now the yield currently is at 2.65, which isn't that big. However, the amounts per share is almost $5 at $4.88 with an annual payout, guys, of, look at this, $19.52. This is by far one of the biggest annual payouts in dividends I have ever seen ever. I think the only other one that I've seen just as big is Broadcom, which is why I absolutely love Broadcom. But man, when I first saw Blackrock, I'm like, $19 per share a year? That is absolutely insane. Now, this does not necessarily mean that they're able to afford this, right? Just because they're paying it doesn't mean that they're able to afford it. We're going to take a look at other metrics later in the spreadsheet to see if they can actually afford this dividend. And we're going to take a look at the payout ratio in regards to the cash flow. However, looking at the payout ratio in regards to the income, we see it at a nice healthy of 42.18%, which is actually fairly good. However, companies don't use their net income to pay out dividends, they use their free cash flow. So we're going to take a look at this in regards to the free cash flow. Now, seeing that this dividend is at $19.52, the 5-year growth rate on this dividend is also very, very good at 13%, which is it's just incredible. Anything above 10% or anything in the double digits with a massive dividend growth already as it is at $19. And also, guys, take a look at this, consecutively increasing and paying out this dividend for 18 years. That is incredible as well. So for all of this is pretty much just showing that when it comes to a dividend, this actually might be a really good dividend play. Now, ex-dividend actually passed as of March 4th. Payout date was on the 23rd, and they pay their dividends quarterly. Now let's move over to the calculator. We got the ticker symbol BLK, market cap of almost $112 billion. PE, guys, of 19.26. So based off of their earnings, this is pretty much telling me that at the current share price of $736.10, this might be a pretty decent buy. However, you can see it is fairly close to my 20 mark, and we need to take a look at other metrics to come up with an even more accurate representation of the company, because this only takes into account earnings, it doesn't take into account share dilution or share buybacks, doesn't take into account cash flow or anything like that. Now, as we saw, when it comes to their dividend, they do pay a $19.52 dividend per share annually, which is, again, massive. Now, this comes out to be almost $3 billion being paid out in dividends every single year, guys, which is massive. And unfortunately, in regards to the 5-year average free cash flow, this only comes out to be $528 million that they have left after paying this dividend, which ends up being 84.86% of the payout ratio in regards to the free cash flow. As I always say, I personally like to buy anything under 60%. 84.86, essentially 85. This to me is telling me that this is really, really cutting it close. At 100%, they're pretty much using all of their cash flow to pretty much pay off the dividend. Anything more than 100%, they are taking on debt. So yeah, they really don't have room when it comes to, one, probably even increasing this dividend, and two, they may not even have room if something bad were to happen. Imagine if the housing market crashes and now Blackrock has been buying all these houses and now they're upside down on all those homes. And well, they really can't afford to pay off their debts because they don't have a lot of cash flow left, meaning that they'll probably either take on debt or lower this dividend. Now let's take a look at the fundamentals, starting with the net income 5 years ago of $5 billion to 1 year ago of $5.9 billion, increase of 19%, which is actually fairly decent. Blackrock is a huge corporation, so it's going to be significantly harder for them to grow rather than a small company that is just starting up, right? Nonetheless, this is actually looking pretty good. Obviously, Obviously, they did have a small dip on the 4, 3, and 2 years ago in comparison to 5. However, 1 year ago, they did completely skyrocket to $5.9 billion. Now let's come over here to the cash flow, the lifeblood of the company. This right here is the cash from operations less your capital expenditures. This is what we use to come up with a target share price in the future based on discounted free cash flow. So this is actually really important. So 5 years ago, Blackrock had almost $3.8 billion in free cash flow, and 1 year ago they were at $4.6 billion. That's an increase of 21% with an average per year free cash flow of almost $3.5 billion. And very similar actually to the net income. 4 years ago, 3 years ago, and 2 years ago, they were essentially down as comparison to the 5 years ago, but then 1 year ago they just completely skyrocketed all the way up to $4.6 billion. Now let's take a look at the revenue 5 years ago of $13.6 billion to 1 year ago of $19.4 billion. There's an increase of 42.46%, and unlike the other two profit metrics, well, we really don't see a dip when we come to the revenue here on the 4, 3, and 2 years ago mark. It is consistently increasing, which is something that you want to see. Now let's take a look at the total assets minus the total liabilities. This metric, guys, pretty much simulates if the company were to liquidate all of their assets, how much money would they have left after doing so, and would they be able to even cover their liabilities. And as you can see right here, currently, if Blackrock were to do this, they would still have $8.3 billion left in their assets minus liabilities, which is actually really good. Now, something to note here also is that pretty much within the past 5 years, they have also been above water every single time. 3 years ago, they did go down slightly to $5.2 billion, but then again, 2 years ago, they completely recovered all the way up to $9 billion. So that's actually really good. They're able to cover their liabilities now with their assets, and they have been above water throughout the past 5 years. Average total assets is around $26.6 billion. Average total liabilities around $19.1 billion. Average assets minus the average liabilities, we get around $7.4 billion. Now let's take a look at the shares outstanding, a metric that people tend not to understand or even not know that it exists. And this one pretty much just tells you whether the company is diluting you as the investor or giving you a bigger piece of the company. The more shares the company issues, the less ownership of the company you have. Take it as like a piece of pizza. Let's say you have a piece of pizza that's X big, right? And you want to share it within 10 different people. The way that you would slice that pizza so that all of those 10 people will get the same amount of pizza slice would be a certain amount. But now if let's say you bring in 20 people instead of 10 and you keep the same pizza, meaning that you do not bring any more pizza to the table, well, the slice of pizza for person will actually decrease. It's essentially the same concept as it is with the shares outstanding. So you want this number to be coming down and not up. As you can see right here, Blackrock is buying back 5 years ago of 161 million shares to today, guys, of 152 million shares. On the 5 year, this is a decrease of 5.78%. And from the previous year to the current year, so we're taking this from the 2 year to the 1 year, it is a decrease of a little bit more than 0.5%, which is really good. And lastly, let's take a look at their cash equivalents. And currently, they have around $9.1 billion in cash equivalents with an average cash equivalents of $7.4 billion. Now for the part that all of you guys want to see, and that is my target share prices. 3 different assumptions, low, medium, high, using 3 different factors: revenue growth, predicted share buyback, and required rate of return. For the revenue growth, guys, I'm going to be using the revenue growth tab in Seeking Alpha. I look at the revenue growth year over year and the revenue growth forward, and then make an assumption based off of those 2 numbers and also how big the company is and how likely are they to grow into the future. For the predicted share buyback, I like to take a look at the shares outstanding that we just did. I like to go a little bit below and a little bit above to where the 5-year average is. And lastly, for the required rate of return, I like to keep it at 10% to match the S&P 500 gains on the best years. So with all of that said, for my lowest assumption, I'm going to assume a revenue growth of 10%, predicted share buyback of 4%. This comes out to be, guys, $523.99. For my median assumption, I'm going to assume a growth of 13%, projected share buyback of 5%. This comes out to be $584.27. And for my highest assumption, I'm going to assume a growth of 16%, predicted share buyback of 6%. This comes out to be $650.11. Now we need to adjust for debt. And the way we do this is we take the cash equivalents and we add the net debt. And doing so, this comes to $522.21 for my lowest assumption. For my median assumption, it is $582.47. And from highest assumption, it is $648.29. Now, me personally, I like to add a margin of safety of 5, 10, and 15%, just so that way you don't overcompensate. You have a margin of safety, you have a cushion just in case things were to happen. The more you pay for something today, the less returns you're going to have in the future. Therefore, you want to have a cushion just in case things really go south. Now, with a margin of safety of 5, 10, and 15%, for my lowest assumption, I would like to personally buy between $444 or roughly, all the way up to $496.10. For my median assumption, I would like to buy a little bit above $495, all the way up to $553.34. And from highest assumption, I would like to buy just slightly above $551, all the way up to almost $616. Guys, the current share price is $736.10. So pretty much wherever you see right here, this is still pretty much a little bit overvalued. However, this is where I always tell everybody, these revenue growth, predicted share buyback, and even the required rate of return are all my assumptions. This is where I'll always say, guys, make your own assumptions. I have this calculator available for free. It's in my discounted free cash flow calculator video / playlist. And you guys can get the calculator. It's for free. Just come over here, you put in the company that you want, and you make your own assumptions, because changing these assumptions just slightly will completely make or break whether you buy the company or not. For example, let's do this. Let's say that you believe that the revenue growth will increase by 25% in the next 4 years, and that they're going to buy back shares at 5%. Well, now, so you guys can see right there, the target share price is pretty much skyrocketed all the way up to $849.50, not adjusting for debt, and $847.70 adjusting for debt. So as it stands right here, this might be a pretty good buy at the highest point if you believe these assumptions right here. So again, it really does depend up to you and what you believe this company is going to do in the next 4 years. Now, I'm not telling you guys what to buy. As I always say, you guys make your own assumptions. This is not financial advice. I'm just showing you guys the raw numbers and what I would pay for this company at the current value. And also, guys, I recently just put out a video of a new calculator I just put out that is figuring out the intrinsic value of a company based on using book value, and that calculator only works for banks, insurances, and maybe utilities. So if you guys have those kind of companies in your portfolio, you want to see what kind of value you should pay for them, well, I have a calculator now available that allows you to see whether banks, insurances, and utilities might be overvalued. So all I'm really asking, guys, for giving out these 2 free calculators is just hit that like button, hit the subscribe, hit that bell, and of course share with people that maybe want to start investing, or that maybe already invested but they want to have a process in a fundamental basis to figuring out what to pay for a company. That's really, really helpful. Again, thank you so much for all of you guys who have subscribed. We're at 505 subscribers. That's absolutely amazing. Love every single one of you. Thank you so much for the help. And here's to another 500 till we get to the 1,000 subscriber mark. Now let's take a look, guys, at the dividends at current price. As I said, when it comes to Blackrock, this is actually something that really intrigued me because they pay a massive dividend on the annually, right? $488 per share at a whopping $19.52 annually per share. That is absolutely incredible. So let's see how much you would make if you were to put in 1 month's income, taking the average US income per year at the $68,703 mark, bringing this to the monthly income. This is $5,725, and seeing that once again they do pay a $19.52 per share annually, putting in 1 month's income into this company would only get you guys 7.78 shares, which is actually really, really small. Now, in the form of dividends, this would come out to be $151.82 annually, $37.86 quarterly, and $12.65 monthly. So as it stands, guys, this is a pretty good dividend. Don't get me wrong, it's absolutely amazing, but seeing that the price is this expensive, you are barely getting anything out for your money, right? You would essentially want this value to come down, because the more this share price comes down, the more this $5,725 actually buys, which means that you will actually get more dividends in the long run. All in all, guys, when it comes to Blackrock, I was honestly fairly surprised. I thought that this was going to be a pretty good company, and don't get me wrong, when it comes to their metrics, they're very, very good. However, the one thing that's really, really scaring me is this payout ratio in regards to the free cash flow is at 85%. This really, really does worry me, because if anything happens, then they actually might cut this dividend because, well, they're really paying out majority of their free cash flow in this dividend, which again is not good. In my opinion, that's just not good. Real estate companies are different. They are forced to pay out 90%, I believe, more than 90% of their revenue in the form of a dividend, but BlackRock is not a real estate company. So again, it's just something that's really worrying me. Aside from that, all their fundamentals look really solid. So if this company does intrigue you and you want to take part of it, then, well, this calculator pretty much just shows that you may want to wait until this company drops probably around like $100 or so, based off of my assumptions. If you put in your own assumptions and you see that, oh, this actually is a good buy now, then, well, you might want to buy it at the current share price of $736.10. That pretty much does it for this video, guys. Like if you like, comment, subscribe. As I said before, it really does help. Thank you so much for the 500 plus subs. Absolutely love it. Have this calculator for free, have the new calculator for free, and if you guys would like to follow me on my new tech sites, BitChute, Odyssey, and Rumble, the links will be in the description below. And if you want to follow me on my Let's Play channel, currently playing through Sonic Unleashed, the link will also be in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.